Welcome to our listeners on this bleak and rainy Tuesday afternoon in Toronto. And thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our investment strategy. So sit back, relax, and perhaps grab a glass of wine. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague, Paul Tepsich, the founder of HighRock. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HighRock tab. So let's start with what happened since we held our last webinar. First, let's see what the top trending Canadian Google searches were last week. As Justin Trudeau and his cabinet were sworn in last Wednesday, over 500,000 Google searches were initiated. On Thursday, H&M released their Balmain collection. And for those of you who don't know, Balmain is a haute couture fashion house. It was founded by Pierre Balmain, a king of French fashion. H&M stores around the world witnessed huge queues, with some hopeful shoppers getting in the line 12 hours before the collection went on sale. I don't make this stuff up. Antoine Joseph Adolphus Sax was a Belgian inventor and musician who invented the saxophone in 1846. On Friday, on the 201st anniversary of his death, we saw over 500,000 Google searches. Now, for Canadian football fans, the Ottawa Red Blacks were Saturday's top search, coming off a 2-win 2014 season and now a 12-win season and winding up in first place in 2015. That's the first time since 1978 an Ottawa CFL team had wound up in top spot. Sunday's top search was Sia. Sia, Kate Isabel Furler, sometimes referred to mononymously as Sia, is an Australian singer and songwriter. She started her career as a singer in the local Adelaide acid jazz band Crisp in the mid-1990s. Hedy Lamarr was an Austrian and American film actress and inventor. Lamarr, who on what would have been her 101st birthday, was honored Monday with an animated doodle on Google's search page. So there you have it, top Google searches last week in Canada. Still no financial news there. So because there is nothing on financial news in the top searches, let us give you our weekly recap here. U.S. and Canadian bond markets were weaker after bond investors continued to revise their expectations for the U.S. Federal Reserve's next interest rate increase after stronger than expected U.S. employment data last Friday. More on that in just a minute. U.S. and 10-year yields continued to rise to levels not seen since July. This will put upward pressure on longer-term mortgage rates. Not a good thing for overextended homeowners. More on this a little further along in our discussion. The World Equity Index was lower by 2.25% despite strength in Japanese and Chinese equity markets. Interestingly, both stocks and bonds are trading lower in correlation, which defies most of the common theory of the negative correlation normally that occurs between stocks and bonds. So both stocks and bonds overall lower on the week. Well, the World Equity Index tested and failed to break above the downtrend that began last May. This indicates that a retest of buying support will need to take place. The first level of support is about 2% lower than the current levels and 10% lower than the highs last May. The second level of support is at the September lows, approximately 8% from current levels and 16% from the May highs. The third level of support is at the August lows, approximately 12% lower than current levels and 20% lower than the May highs. We think that there may be good value if we can get to that third support point. Well, greed peaked last week and has turned lower. We want to wait for extreme fear to buy the equity assets that we want, because that's where we will find value. Until then, we will remain in a more defensive, cash-heavy position in our equity portfolios. I will also address this a little more in a little more detail further along in the discussion. Well, with the U.S. dollar rising after the U.S. employment data, it certainly did not help commodity prices, which fell across the board, led by oil. But copper, which is definitely a leading indicator of the global economy, is testing its August lows just a little above that $2.20 level. We'll have to keep our eyes on that to see what happens in the follow-through. Meanwhile, the Bloomberg Commodity Index is at its lowest level since 2011. Well, volatility moved higher over the last week, back to its 200-day moving average after we saw the U.S. employment data. So let's go look and see what did happen in the U.S. last week. Well, as I mentioned, Friday, the U.S. employment situation report showed a significantly stronger than expected and on many fronts. So that may be enough to lead the U.S. Federal Reserve to begin raising interest rates, or so think many of the economists and analysts that are constantly analyzing these numbers. The headline number grew by 271,000, and the unemployment rate fell to 5%. The labor force participation rate remained at a multi-year low at 62.4%. Now, behind the scenes, the closely monitored wage inflation data showed a significant uptick. This could be enough of a catalyst for the U.S. Fed to begin the process of raising interest rates when they meet again in December. Remember that they want to see indications that inflation will be returning to the 2% level. That may have happened now with wage inflation starting to appear. On other news, we're going to talk about wholesale inventories to sales, and Paul wanted to have a word on this.
Thanks, Scott. Yeah, this is kind of an interesting chart, but as the title implies, it's the ratio of wholesale inventories to sales. So this really has to do with the U.S. manufacturing process. And I think, well, you can see by the chart, obviously, what's happening is inventories are rising to levels where you can see the pink shaded areas. When the ratio gets that high, we are typically in recession, which is a scary thought, but it is what it is with regards to this series of data. But really what this typically means is through the manufacturing stage of production, companies are doing what's called channel stuffing, and they're basically pushing inventory into other buyers, and so suppliers are pushing inventory into other buyers, and those buyers at some point in the process, as you can see by the chart, are getting stuck with that inventory. And that is obviously very problematic. If this doesn't start turning down soon, I believe it's a harbinger of things to come. And just another aside, on a chart a few ago, Scott talked about last Friday's non-farm payroll, the unemployment numbers that came out in the U.S., and they came out in Canada as well. And the headline number was rather impressive at 271,000 non-farm jobs were created. The problem was twofold. Number one, most of those jobs were created in the 55-year-old and greater demographic. The 24 to 54-year-old bucket had very few jobs created. And the other interesting thing that goes along with this wholesale inventory to sales ratio is there were 0 jobs created in the manufacturing sector, 0 across the month of October. So we need to keep a really close eye on this thing right now. Thanks, Scott.
Yeah, well, that also goes well with some of the data that we've been talking about over the last few weeks, showing that factory orders were declining, manufacturing orders were declining considerably. So we seem to have a bit of a dichotomy in the U.S. economy where jobs are being created. Wages do appear to be rising, and yet there are signs that parts of the U.S. economy are in fact slowing. So obviously these are things that the U.S. Federal Reserve has to take into consideration, but I think, and they seem to have, because of this focus on employment and subsequently on inflation, without and of course inflation will be not only just wage inflation, but we have to continue to watch the commodity prices, which are certainly showing signs of deflation. So there's a lot of things going on, and at the moment there seems to be some sense that given their stance, the Federal Reserve is being backed into a particular position where they may have to, for credibility purposes, raise interest rates in December. But again, we'll see what the bond markets tell us in just a second. You mentioned, Paul, in Canada, we did also get employment data, and after 4 months of little change, employment actually increased by 44,000 jobs, which is about 0.2% during the month of October. That brings the number of people employed in Canada to over 18 million as a whole number for the first time. The unemployment rate declined by 0.1 percentage points to 7%. Now, compared with 12 months earlier, employment is up about 143,000 jobs, or 0.8%, with all of those gains coming in full-time work. Ontario, British Columbia, New Brunswick, and Manitoba saw gains in employment in October, while Alberta recorded a decline. There was little or no change in other provinces. Last week we pointed out that the UBS Global Real Estate Bubble Index put Vancouver at number 4, and also at the same time the Canadian Mortgage and Housing Corporation, otherwise known as CMHC, issued a report warning that home prices were now outstripping fundamentals in 11 of 15 major markets, and that 4 cities, Toronto, Regina, Winnipeg, and Saskatoon, faced serious headwinds because of high prices and a surge in the supply of new homes under construction. Well, now we can add the Organization of Economic Cooperation and Development to the list of forecasters suggesting that Canada's housing market is overheating. And on the heels of that discussion comes a study from the Canadian Centre for Policy Alternatives called The Young and the Leveraged. This report is assessing the impact of a housing market correction on Canada's homeowners. And the study finds that young homeowners would be hardest hit by a correction in Canada's housing market. CCPA senior economist David McDonald assesses the impact of a housing market correction on the net worth of Canadian families and finds that a 20% decline, which is what the Bank of Canada does anticipate, that 20% decline in real estate prices would leave 169,000 families under the age of 40 underwater, with resulting with from more debt than actual assets. Now, Canadian families are taking on disconcerting levels of debt to finance their real estate dreams. The average debt-to-income ratio of 30-somethings has almost doubled since 1999, hitting a new high of 4-to-1, the highest of any age group. Very interesting look at this situation, and again, we've been talking about this for a couple of weeks, and I do mention it from time to time in my blog, but debt levels, not just in Canada, but around the globe, have risen to extremely high levels on the back of extremely low interest rates. So any increase in interest rates, or for that matter, any decrease in the prices of assets are going to significantly be harmful for those who have borrowed to buy houses or actually invest. Well, around the global economy, the Bank of England Monetary Policy Committee voted by a majority of 8-to-1 to maintain the bank rate at 0.5% and unanimously to leave the stock of purchased assets at £375 billion at its November 2015 meeting. Now, policymakers lowered their inflation and growth forecasts and said the outlook for global growth has weakened, signaling the central bank is in no rush to raise rates. And that's a bit of a backpedaling for the Bank of England since a couple of meetings ago. Now, the central bank lowered its 2015-2016 GDP forecast to 2.7% and 2.5% respectively, and raised their forecast for 2017 to 2.7%. Now, the bank expects the inflation rate to remain below 1% until the second half of 2016, and then to reach 2.1% in the third quarter of 2017. Why they will probably step back from raising interest rates there. The outlook for global growth has weakened since the August inflation report. Many emerging market economies have slowed markedly, and the committee has downgraded its assessment of their medium-term growth prospects. While growth in advanced economies has continued and broadened, the committee nonetheless expects the overall pace of UK-weighted global growth to be more modest than had been expected last August. There remain downside risks to this outlook, including that of a more abrupt slowdown in emerging economies. So that continues to follow a theme, Paul, that we've been talking about on a regular basis, that the global economy is definitely showing signs of slowing, and a lot of central bankers are taking notice. Meanwhile, in China, the trade data last week pointed to slowing and continuing deterioration in both imports and exports. And this morning we saw inflation data, which was reported to be less than the expected, or a less than expected 1.3%. Now, China's economy grew 6.9% in the 3 months through September from a year earlier, the slowest quarterly increase since the start of 2009. For the full year, growth is set to be the slowest since 1990. Top leaders have signaled that they won't tolerate a sharp slowdown in coming years, and President Xi Jinping said last week that average annual growth should be no less than 6.5%. What we see there is potentially even further lower interest rates and potentially some further central bank stimulus. Well, on the back of all that, the Organization for Economic Cooperation and Development, more commonly known as OECD, has joined the many who have lowered global forecasts for 2015, now expecting the world economy to grow at a rate of 2.9%. They do expect a modest upturn in 2016 to a 3.3% level, carried mostly by slightly better growth in the euro area and in Japan. Well, what do we see coming? Well, from the bond markets, we see that yield curves steepened as longer-term investors prepare themselves for higher levels of future inflation and perhaps higher interest rates on the back of the U.S. employment data. U.S. 10-years move closer to that 2.5% level, and other government 10-year bonds followed them higher. Now, in the short term, U.S. markets have priced in a 70% chance of a Fed rate increase at the December meeting. So that does give us some insight into what these markets are expecting. Also at this point in the short term, German yields have remained negative out to 6 years. So again, we've got some divergence in what's going on in the short end of some European markets, but in the longer end, we're still starting to see interest rates moving higher. High-yield bonds historically lead equity markets. The high yield turned lower earlier in 2015, and in August, the S&P 500 followed. Now, recently, we've seen the S&P 500 move higher, but this move has not been led or verified by a move in high yield. So history will tell us that U.S. equities are ahead of themselves. Of course, we think that they're going to have to correct lower to lessen the current level of divergence between these two indicators. We remain convinced that equity markets are expensive, and of the 444 companies that have reported earnings to date on the S&P 500 for the third quarter of 2015. 74% have reported earnings above the mean estimate. Now, the 5-year average is for 72% to report above the mean estimate. So we're pretty much in line with the norm here. But 46% have reported sales above the mean estimate, and the 5-year average there is 57%. So sales are generally below average, and that means revenues are generally below average. For the third quarter of 2015, the blended earnings decline is 2.2%. So if we have an earnings decline in the third quarter, which looks quite likely, it will mark the first back-to-back quarter of earnings decline since 2009. For companies that generate more than 50% of their sales inside the U.S., the blended earnings growth rate has been just a little under 5%. However, for companies that generate less than 50% of sales outside the U.S., the blended earnings decline is 10.6%. So as might be expected, the slowing global economy is having an impact on earnings. Analysts are estimating earnings for fourth quarter of 2015 will decline by 2.7%. So we could possibly have 3 quarters of declining earnings. With earnings declining and stock prices rising, the price to earnings ratio is rising. Stock market or making stock prices more expensive. The 12-month PE ratio is 16.6 compared to the 10-year average of 14.1 and the highs that we saw at the peak of the stock market last May at 17. The other metric that we like to look at on a weekly basis is the enterprise value to earnings. The S&P 500 companies are valued at a current level of almost 13, and the 10-year average is about 10.8 times. And as we have mentioned and do mention on our weekly calls, in our tactical growth model, we don't really care about investing in anything that is over 8.5 times. Another metric that we like to monitor is the rate of margin debt. When investors and traders borrow on margin to buy stocks, margin debt rises. When investors and traders decrease their margin debt, this tends to lead stocks lower, as it did in 2007 and 2008. Now, the most recent data shows that margin debt has been reduced from record levels, but stock prices actually have risen subsequent to that. Again, here is a traditional correlation that is seeing a divergence. Well, we think something has to give at some point, so this definitely sends up yellow flags for us. Well, the Fed is focused on economic data between now and the next meeting, and certainly we've seen the employment data from last week, which will have an impact. But there is more data coming, so let's have a look and see what will be released over the course of the next week. On Thursday, we will get lots of Fed governors speaking, and that may give us some clues as to their thoughts about higher U.S. federal or U.S. interest rates. On Friday, we'll see the Euro area third quarter GDP, as well as U.S. retail sales and U.S. producer prices. On Sunday, we'll get the Japanese third quarter GDP. Then on Monday, we'll have Euro area inflation, followed on Tuesday by U.S. CPI for October, U.S. industrial production for October, and U.K. inflation. So we'll be able to update you next week on how all of these have been reported and what we think the impacts should be. Well, what does it all mean? We say this regularly, but we are in a low return environment in this part of the cycle where we see global debt levels at record levels. The global economy has been slowing. Central banks are moving in different directions, or seemingly so, and we can expect, as a result, volatility levels to increase as uncertainty becomes more prevalent. Now, overvalued assets will experience a correction to more reasonable price points as this all occurs. Well, as we mentioned last week, our discipline is to protect our and our clients' capital in times like this. Now, we're not alone in this thinking. We get credibility from other well-respected economists who agree with our view. Cash and cash equivalents are important defensive assets, and we cannot stress this enough. So we are carrying greater than normal cash balances in our models. Now, this is a short-term strategic allocation shift that we will use to protect our and our clients' capital. It also gives us the ability to put that money to longer-term work when asset prices get cheaper, as we believe that they will. Now, when new cash is added to a portfolio, we may determine that it is not an appropriate time to put that money to work because an asset might be overvalued. So we are prepared to wait for that asset to get to a more appropriate price point that represents better value. Now, there may be a waiting period for this to happen, so we may put the money to work in a short-term money market vehicle that does actually give some return. However, the benefit is that our and your money not get repriced lower while we wait, and we are able to purchase at a better price. So opportunity gained and ultimately value added. So if you see extra cash or cash equivalent in your portfolio, it is because we believe that in the short term there is an opportunity to take advantage of.
Scott?
Paul?
Could I just add, too, that the cash we're holding is in an overnight short-term interest account that is a Schedule B Canadian bank that we've done a fair bit of work on. We're comfortable with the credit. I know the CEO personally, and we move in and out of that, but typically we are invested in it, and it is currently yielding all of us 1.7%, which is, quite frankly, today what a 10-year Government of Canada bond yields. So it's a pretty stout yield for sitting in cash, and we are comfortable with the credit risk that we're taking on an overnight basis.
Thanks, Paul. Well, I mentioned the short-term strategy there, but long-term, depending on your tailored strategy, you can expect that we'll use this short-term strategy to build on your average annual return, which is an assumption in your wealth forecast. Now, if we can improve our average annual return with short-term strategic tactics, that'll help us to outperform our targets, and that's always something that we want to do, and that's why you pay us a fee, to get the added value that our expertise brings to the table. What is really most important, of course, is that reaching your long-term goals. That's why everybody needs a wealth forecast in order to set up a properly constructed strategy. Now, there are new taxes proposed that Canadians voted for in their need for change. Without a wealth forecast, you can't be certain as to how you will be affected, how your goals may be affected, and how your portfolio strategy will need to be adjusted. So we'll be contacting all of our clients over the next several weeks to make certain that you are all aware of how you will be impacted. Now, if you don't have a wealth forecast, it is definitely time to come in from the land of uncertainty. All right, well, that's it for today's discussion. If anyone might have a question, please feel free to ask it now.
I am confused as to why both the stocks and bonds are negative. Why? What's happened that it's become this way? Because this is new to me.
Yeah, well, it's normally and over longer periods of time, historically, we find that stocks and bonds are negatively correlated. So what happens when stock prices start to fall, investors get nervous and move out of the riskier asset and into the safer asset, which would drive bond prices higher as more money flowed into bonds. Now, what we're seeing here is the concern over higher interest rates. So bond investors are saying, well, if we're going to get higher interest rates, then bond prices are likely going to fall. So we're going to get out of bonds, maybe move into cash temporarily, and wait for those bond prices to get to more attractive levels. At the same time, you've got stock traders saying, well, if stock prices are going down, we want out. So instead of going into bonds, they're going into cash, which again drives stock prices lower. But we do see a general move to a safer asset class, and cash is a defensive asset class. So at this particular moment in time, we're seeing both selling in bond markets and selling in equity markets, which is not a normal circumstance, but that may change down the road at some point in time. Paul, did you want to add anything here?
No, that was pretty good. I mean, it's also fair to say that with the expectations that interest rates may go up from the Federal Reserve Board in the front end of the yield curve, that the back end of the yield curve, like 5-year, 10-year, and 30-year bonds, got a little bit nervous. But at some point, you will see a flight to quality. So we've had a pretty big move. I'm just going to look here on 10-year treasuries, 10-year U.S. treasuries. We'll look at those. And Scott had the chart up, but I mean, over the past week, the past 4 to 6 weeks, we've gone from 1.9 to 2.4, almost 2.35, call it. So we weakened off 45 basis points in over about a 4 or 5 week period. That's a pretty substantial move. I would hazard a guess that if the stock market plays out the way we expect it will, that there will be a flight to quality back into the safety of U.S. Treasury bonds now that we are at these wider yields.
Okay, thanks.
All right. Well, that's great. If anybody who is listening to the recorded version has questions and wants to email us, we would be more than happy for you to send that in. We'd also love to get feedback on these webinars, what you think is good, what is not, and what else you might like to see us cover on these calls. But that's it for another week. So thank you all for taking the time to tune in. Have a great rest of the week, a wonderful weekend, and we'll be back with another report next Tuesday. This is Scott Tomlinson signing off.